Is going on, everyone? Another wonderful Tuesday night. Honestly, I love these calls keep me in check with what day of the week it is. I was about to say Monday. I realized I wouldn't be sitting here at this time if it wasn't a Monday. So thank you all for keeping me in check with that. Because after Wednesday, my schedule's out of whack. I don't know what day of the week it is anymore. But yep, we're here on another wonderful Tuesday. Thank you all for joining. Multifamily Napkin Underwriting Zoom. Brought to you by yours truly, Multifamily Freedom Chasers. And I'm kind of excited for today's talk, so we'll see how that goes. And we already have a deal to underwrite, which is awesome as well. Thank you. Shout out to Peter.
Oh. All right. Well, as always, we try to keep things tight on a timeline and on an agenda. So today, like always, we'll introduce ourselves. We'll want to hear from you. We'll talk ecosystem, go through our topic, and underwrite some deals. Actually get down to the practical trenches of underwriting or multifamily here. Quick underwriting anyway, napkin stuff. So, and then of course we'll open it up to Q&A here, there, and everything, everywhere in between. So, with that said, who are we, Ed? Who are we, man?
So, as some of you probably have already heard me say multiple times, my name is Edward Shamirian, based out of Los Angeles, California. Licensed agent out here, focused on multifamily investing just because of I love the high level of it. It's like playing real life Monopoly with high stakes, and it's fun for me. I get a thrill out of it. So I kind of use that creativity to specialize in the underwriting, offering, getting wacky with the fun creative deals, which I know everyone loves to offer nowadays, given the market we're in. But yeah, I love to help out people in the community. Always feel free to reach out to me. My number's in my name. So yeah, looking forward to connecting with you all if we haven't before. Let me know how I can help, and I'll let Will and Aldo take it from here.
Go for it, brother.
Good evening, everyone. Hope everyone's doing well this evening. Hey, my name is William Otis, and I am here with my business partner and ride or die friend for many, many years, Aldo and Chetta. And we're co-founders of Stoke Holding Solutions based out of Chattanooga, Tennessee. And Aldo and I are a couple W-2 guys that have a passion for real estate. And we've spent collectively 25 years combined experience in senior living. With emphasis and focus in operations and asset management. And that's really given us a great overview of this space. And so we're taking what we've learned in senior living and applying that to multifamily housing. And so we're excited to be here. And it's an honor to be here with Ed. And yeah, so we're excited to get this evening going, and we want to know who you are. And so if you're new here, if this is your first night, please throw a 1 in the chat. We'd love to get to know you. And also, if anyone is feeling brave, we'd love for you to raise your hand and introduce yourself and tell us a little bit about you. This is your time to get known and be able to share about what you're about. So so if no one volunteers, then we will voluntold you. So anyone want to raise their hand? All right, well then I'm going to start asking people. So Leanne, I know you went and saw some amazing people in concert in New York City. So tell us a little bit about you and what brings you here tonight.
Well, I always love underwriting. It's one of my weaker spots. I'm more of a capital raiser, so but I need to know it so I can make sure I understand it for my investors, and that's why I'm here. I love this community. I love how everybody just shares their strengths and is willing to help everyone out, and that's me.
Awesome. Well, hey, we're glad to have you here, and you've come to a good spot to learn from the masters, Ed and Aldo, on underwriting. I'm just here to be a part of this Zoom because Aldo's here. So, no, I'm
Yeah,
glad.
but you got a hat. I didn't even get that.
True.
I didn't
Well,
get the
because-
memo.
That's because we're Waldo and not Ed. So
That's
Hey, I'm
right.
so happy you said it because I didn't want to be the one bringing it up on the
Hey,
Zoom.
we could be
so-
Eduardo, all right?
yeah, there we go. Ed Waldo, there we go. Hey man, even better. So Ed, we're gonna fix
no.
you up, bro.
We sound like a Mario character.
Hey, we already look like it. So anyway, Jaden, what's up, brother? Looks like you're
No,
lifting
hey,
some weight,
hold on.
man.
There's no way Jaden can talk. This guy, like, that's not fair. Like, that's not like way to make us look bad. Like, come on, Matt, give me a shot. Like, no, go for it, Jaden.
You're muted,
You're on
brother.
mute,
Let
bro.
me see if
You're
we
muted.
can unmute you.
You're still on mute. Can you hear? Oh, there you go.
Thanks, brother.
Here we
Yeah,
go.
I'm Jaden from Washington State. I guess I know some of you guys have already seen me, but I'm probably not a capital raiser yet. Underwriting is probably kind of what I've been seeking to learn and understand more. So, but mine has all been, napkin and paper born, not so much spreadsheets. So the spreadsheet stuff has kind of been a little bit more new. I need to just sit down and take the time to learn it more, but I've been more the sit down with a notebook and pencil it out. That's kind of been my expertise on that deal. And I guess my thing I would like to learn or get better at is how to just look at a deal, not give it more than 5 minutes, at most, if it doesn't deserve more of my time. And I guess that's where I'd like to learn is how I can really quickly analyze a deal and say, yep, no, that one's garbage, pass it on and go on to the next.
Well, brother, you've come to the right place, man. That's what
right.
Will and I do on a daily basis, man, right here. And actually, in fact, we did that just last night. I think we went through like 5 different deals. Because we have W-2s, man, and we're busy. We've got family, we've got a bunch of stuff to do. So we want to do things efficiently and effectively, true to the MFC way. So you've come to the right place. So welcome, man.
I want to
Thank
jump
you.
in real quick too and make a point on something you touched upon. As much as knowing the calculator and the real estate side of the underwriting, if you are using an Excel sheet, remember that it is still an Excel sheet. If you don't know exactly how, like what the word means, knowing Excel will just allow you to figure out how the number came from, like where it came from, how it got there. So you can really learn it all just by dissecting the Excel formulas and just looking through the calculator and how it works. And I always tell people this, like the calculator I got really good at, it's not the one that everyone has, but I got really good at it because I dissected it so much. I played with that around with it so much. When I changed the percentage, I knew what changed and by how much, no matter how much the value of the property was. So I got so good at just running multiple scenarios on it that it became clockwork. I tell everyone this, but I honestly think there's a lot of truth to it. If you deleted the entire numbers and formulas of the Excel sheet, I'd be able to put it back. Like I just knew it that well. And that doesn't mean I knew the real estate as well per se. I just get so comfortable with the formulas, and when you change something, you see where it correlates to, that it becomes second nature. You kind of just know what's changing. So if you're not, and I'm not saying you specifically, but for anyone listening, if you're not so comfortable with like, I don't know what this means, I don't know what this does, why does this do that? Just look at the formulas, see what it correlates to and translates to, and what that changes make. It's all trial and error. So I think the more comfortable you get with the actual Excel component of the calculator, the easier it is, personally.
Absolutely. Absolutely. Thanks for that, Ed. As always, we kind of plug in our own community here and our own ecosystem. And just to quickly go through this, there are several different Zooms that you can join to receive value in different key stages of the real estate journey. The first one being activated. Your mindset has to be right. And on Sundays, we have great celebrity speakers that come in and do just that, activate us for the week. And that is Sundays at 8 p.m. That time is changing, so 8 p.m. And then, of course, what's the first step to, getting into real estate? Finding a deal. Got to talk to brokers. So on Mondays, you log on with Ed and Pete, and you talk to brokers. You learn what that's like, and you try to find all the information that you need, so that then you can bring it to our Zoom on Tuesdays, and we can do a quick napkin underwriting and see if it's a dud or a stud. And then, of course, we have alternating Zooms on Wednesdays with the Miles family and with Victor N to the G. The Miles family, theirs is also at 8 now, 8 p.m. They talk about the debt market. They are the official MFC debt brokers, and they talk about the state of the debt market and about all kind of different debt vehicles you can use to get into commercial real estate, specifically multifamily. And then tomorrow we're going to have a Zoom with Victor, and I'll be on that one myself as well, with him co-hosting that, where he dives it deeper into the underwriting process. And tomorrow we're going to be going over the T12 in depth and to some of the accounting and different things. And he's going to just blow your mind, all the things that he knows and understands. So be sure to plug in somewhere, wherever your weakest spot is, plug into that and just learn. And we're here for you. And did I mention all of this is free? All of this is free. And, our goals and our, mission is to inspire thousands of, W-2 folks, professionals to, find financial freedom out there so that they can live a life that they enjoy. And so with that said, quick plug as well, Marcel and Trevor are going to be in Miami tonight, actually. Is that today the 10th? No, tomorrow.
Oh,
Tomorrow, yeah, that's right. Tomorrow the 10th in Moxie South Beach, Miami, for Fun Launch Live 2023. And they're putting together a little event that night at 6 p.m. Eastern time. There's the address. Take a snapshot of it. If you're around, come see them. There's gonna be some special guests, including Gabe Bolin. If you miss him, he's a awesome dude. Used to work for Grant Cardone, was a capital raiser for him, and he's got his own fund now. Pistol of a dude. So if you're around, definitely go see them. And with that said, this is our contact information. Feel free to contact us with anything, any questions that you may have. If we don't know the answer, we can connect you with somebody that does. So if we can't help you, we'll connect you. That's what we do. All right. Okay, we made it. So today we're going to talk about loans as it relates to napkin underwriting. It's important to know a little bit of what drives the debt side of this calculator. And I'll show you that here. So if everybody can see this, this is the napkin underwriting tool that we use personally. Will and I use this calculator like every single day. This is what we use personally to see if a deal is viable. So if you don't have a copy of this yet and you're new here, just let us know. We can hook you up for free. We'll just give that away. In fact, we built it. Us three, we built this sheet. And so today we're going to be going over the debt overview section of this napkin underwriting tool. And, very simple stuff. Actually, it's going to be very like grade level stuff so that we're all on the same page. A lot of you may know all this information already, but I promise you, somebody here may not know one of the things that we talk about, and it's going to be so helpful to them, hopefully. And so we'll get started with LTV. What is LTV? No, it's not a flooring type. And that's actually LVT. It's a loan to value ratio. And this is what the banks essentially tell you. It's how much you can borrow from the bank, right? It gives you what the bank calls loan proceeds. And that is a percentage of the purchase price, right? So in this case, let's say that the bank says, hey, yeah, we'll loan you money, but we'll give you 70% of the loan. Which essentially backwards, if you think about it from a single family side of things, it's just the opposite of a down payment, right? So it's a 70% loan to value ratio. It's just a 30% down payment, right? Another way to look at that. And so here, then it calculates the loan amount from this percentage. So it'll take this price right here that you plug into here. It'll take 70% of that, and this is the loan amount that you'll receive from the bank. And then we talk about interest rates. Now, we could be here all day talking about interest rates and where we think it's going to go, where we think it's come from, how do we think it's going to impact and affect the different areas of the entire economy, specifically multifamily real estate. But this comes from the bank. Comes directly from the bank. And there's different ways, different rules of thumb that you could use to see kind of a ballpark of, you know, what a rate could potentially be. So, and there's typically two types of loan, generally speaking. There's or two institutions of loans. There's non-recourse, which is Fannie Mae and Freddie Mac, which is called agency debt. And then there's recourse debt, which is just regular banks, private banks. Non-recourse just means that you're not personally liable for the debt. So if it all goes down, you don't go down with it personally. That's non-recourse. Recourse debt is with a bank. So if a deal doesn't work out, the bank is going to go after you personally if after the sale of the asset, it doesn't meet the obligations of the loan. So that's just the basic difference between those two. And then, of course, there's all kinds of different loan products out there that you could use to finance a multifamily asset. With that said, those interest rates are going to vary by product type, vary by recourse or non-recourse. They're going to vary by your loan to value, the risk. There are several risk factors that could affect the interest rate. But if you talk to a Fannie Mae, Freddie Mac loan officer, or, you know, like, so you talk to Jerry and you try to get an agency quote, typically you can get a ballpark estimate by just looking at the 10-year treasury rate, which yesterday was at like 3.53 or something like that, 3.5, maybe more, or 4, was it 4.5? No, it was 3.5. And then you can add 1.5 to 2.5 percentage points to that to get a ballpark. I always go all the way up. So if it's 3.5 right now, I'm going to go to, no, 4.5, apologies. I'm going to go all the way to 6. If it's 4.5 right now, I'm going to go all the way to 6% for this interest rate. Or you can just call up Jerry to say, hey, Jerry, I'm looking at this deal. You know, can you deal me up some quotes? What's the best thing out there for me right now? And he could give you, you know, a quote for either recourse or non-recourse. Now, the thing about non-recourse agency debt is if it's a smaller deal, it'll have to fall under what's called a small balance loans, a small balance program. And that is anywhere between 1 million to 7 million, if I'm not mistaken, $7 or $8 million in proceeds, you know, for this deal. So if it's below that, it won't qualify. And if it's above that, it'll be a different program for agency debt. Okay. Anyway, you call up Jerry, you tell him, hey, this is what I need. And Jerry's going to tell you, okay, great. All I need from you is the rent roll, the T12, the OM, and, you know, just a basic rundown of, you know, what your plan would be for this deal. You know, how do you think it's going to turn out? Right. And so he can usually turn around a quote pretty quickly. And so, you know, what we've been seeing out there has been anywhere between 5.5 to 5.9-ish%, depending on several different factors of how this loan is packaged, essentially. So you could have a higher leverage or a lower leverage or a longer term or a shorter term, which we'll get into. The interest only period is, and it's going to vary differently as well. So anyway, that's the range. And so we put it up to 585 or maybe even 6 just to be conservative. Although, you know, the Fed has pretty much said without saying that, you know, they're going to stop potentially raising the interest rates. That doesn't mean it's going to come down, but it is, you know, a potentially good news for the state. Yes, absolutely. Thank you for putting that up, Will. So anyway, this is what we're putting out there. The amortization part, if it's agency debt, it's going to be a 30-year amortization. If it's non-recourse bank loan, it's probably going to be somewhere between 20 and 25 years for the amortization, which is going to change the loan quite a bit, and it's going to increase that. So this is assuming that we get an agency loan for this deal, right? And then you don't need to mess with the payment. It's going to calculate it already. This is the principal and interest payment that you would pay for this loan, regardless of whether you have an interest-only period or not. Because the next part, the DSCR, stands for debt service coverage ratio. Now, basically all commercial real estate loans are going to be DSCR loans. What that means is that the bank is going to loan you money based on the performance of the asset, and they're going to base it off of your NOI. So what does that mean? It means that you have to have NOI high enough by 1.25 times the amount of the payment. So if your payment is $100,000 a year, then your NOI has to be at least $125,000 a year to be able to cover it and not default on the loan. That's what they prefer for you. Now that varies, of course, and you know, you might see a lower DSCR than that if you're more experienced or you have better relationships, or with an agency loan if they're desperate to lend money. And then on the flip side, if your DSCR is higher than the required amount, then the risk falls and your interest rate could be more favorable as well. So your interest rate could drop as well. So a lot of factors, a lot of factors to consider. And then of course, something that is not on here is the term amount. So in commercial loans, the typical lifespan of a loan is between 5 to 10 years. Even though it's amortized over 30 years, that amortization, that calculation is only valid for the first 5 to 10 years, after which it becomes variable, right? There's a balloon after that potentially. And so which is why most people either refinance or sell a deal after the loan term. So in those terms as well, you have what's called an interest-only period. And if you get one of, you know, an interest-only period, it'll vary based on, you know, the requirements of either the bank or the agency and the risk that is involved here. So, but typically you could expect for a 5-year term, you know, between a 1 to 2 year interest-only period. I have seen it as high as 3 years. For a 7-year, you can start getting into the 3-year interest only. And then of course you can get, for a 10-year loan, you can get up to like a 5-year interest only period. Actually, as a matter of fact, one of our more recent underwritings, we got a quote for a 5-year full term interest only period, which was great, but it was a lower leverage. So it was like 65% LTV. And sometimes that makes even more sense because you don't have to pick up on the principal and it's only interest. So with that said, that's a breakdown of this debt overview. And the reason this matters is because your NOI and your going in cap rate, these things are going to be litmus tests as to whether this is a good deal for you to pursue or not. So if your DSCR is less than 1.25, number one, you won't get a loan on it. Number two, you probably won't be able to see cash returns, cash flow from that, right? So the bank is also interested in your success, in making sure that you get some cash out of this deal, so that, you know, there's some incentives for you there as well. So that's why this matters. And we'll go into, as we talk about a deal today, we'll go into the relationship between going in cap rate and the interest rate. But with that, Ed, Will, anything that we need to add here or that you would like to touch on as well?
Yeah, absolutely. You always know I'm gonna talk. Like, I don't know why you guys ask me anymore. I always have something to say. More of you guys trying to figure out a way to shut me up. But I did want to touch on something that I was actually on Vina Jetty's call a few weeks ago, and we're actually discussing the amortization because something recently has been going on with Fannie and Freddie, I think, if I'm not mistaken, where they are working with numbers being 35 to 40-year amortization. Now, what does that really mean? It means you're spreading out the payment over a longer period of time, which means you're paying less on the principal, which means your payments are lower. So so why that's important is because I'm going to be honest, I don't care if it's a single family house, I don't care if it's a house you live in now, I don't care if it's a multifamily property, you're never and should never live out the life of the loan. Why? Because you're not maximizing your leverage on the debt side to invest somewhere else that's going to make you more money. Bottom line. My friends ask me like, so you tell me you're never gonna, or I'm never gonna pay off my house? I'm like, I hope you never do. Simple as that. Because then that money could be used elsewhere. So that's where the amortization play is, where you don't worry about the payments as much towards the principal because you're doing a value add. This comes to another question that was asked in the chat that thank you, Will, for answering. But the advantage of doing interest only portion is your payments are less. And yes, you aren't going towards, you're not paying your principal down. But I'm gonna be honest, if you're buying in our world of multifamily property, if you're buying it hoping you paying down the principal is gonna be the reason this is a good deal, wow, that's very risky. I'm trying to keep it PG, but that's really, really, like, I don't recommend that by any means. If principal, I want to pay out as little as possible during the life of my ownership of the building for multiple reasons. One, it means more cash flow to you and your investors, which is better. Secondly, you're putting money into the building, your rehab, you have vacant units. Like, you can't rehab a unit if it's not vacant. If it's not vacant, that means someone's not paying rent. It's a very simple correlation, right? So if those payments are as low as possible, you're paying interest anyway. So don't worry about whether it's IO or P&I, because either way, that interest is the same amount. It's just, are you paying anything on top of that? And most of the profits and the equity, or, well, yeah, it's forced appreciation in a sense, it's going to be acquired on the back end, whether you refinance, sell, or whatever your exit strategy is, which I also recommend having more than one, to be fair, just in case. So keep in mind, like, those are very, very important things where I'm trying to keep my monthly payment as low as possible. Also, if you guys want me to get into it, Aldo, I'll let you make the call. That's why assumable debt is so attractive. I can ask more as a seller for a property that I'm giving you an assumable loan at 3.5% compared to the 6 you might get on the open market. My property is way more attractive now. So that's something to keep in mind as well. And that's why people try to charge more than the property is actually worth. I use air quotes, because, hey, my debt's less. You can't find this, you can't transfer this. You want it, you have to buy this. You don't want it, cool. Good luck with your 7%.
Yeah,
So,
that is such a big deal, man, because all things not only have remained equal, but revenue has actually grown because rents have increased. The only factor that has been driving down the pricing or the offer amounts from buyers has been debt because of the increase in the interest rates by the feds. That's been blowing it up, and so it's difficult to afford a deal if you can't pay the debt up for it. So yeah, that makes or breaks the deal in the front end for sure.
sorry,
And then,
oh, go ahead.
no, that's it.
I was gonna say, with the amortization thing, you are gonna have a better chance of getting qualified now and have that leverage adjusted because your monthly payments are less. So that's something to keep in mind as well. all the things about keeping the monthly payment lower and keeping it less while you're holding the property goes two ways. One, your life of the deal is going to be better, more cash flow, but also it becomes easier to qualify. The best way to look at it is you're never gonna get a loan on a property that's gonna be negative. The bank, like 08 kind of kissed that goodbye. Like, it's just not gonna happen. Why would I invest as a lender, trust you with my money in a building that day one isn't even working? No one has that much faith in any investor. I don't care if you're Grant Cardone or any other big name in the industry. It just doesn't make sense from a lending perspective. So that's why these lower payments are so beneficial in the whole process.
That's right. All right. Any other questions on this topic before we jump into the deal here? Which, by the way, what deal are we doing?
We can do Peters.
Didn't we have another one? Didn't Mario send one?
I work with Mario on his
Okay.
yesterday. Yeah.
Okay.
Does
okay.
anyone else here, does anyone else have a deal that they brought with them this evening?
You get a deal. You get a deal.
You
Yeah,
get
William,
the
I
deal.
have a deal if you want to analyze, if you're looking for a deal.
Okay,
Go
yeah, let's
for it.
fill that one up.
I'm sorry?
Yeah, that'd be great.
Okay, so you can plug in the numbers. So it's a 8-unit apartment out of Atlanta. The average rent is $1,050. They're selling it for $125,000 a door.
Did you say it was
How many units is it?
8 units?
8.
8.
Okay, 8 units. Okay, so this equals this 125,000.
A door. So 125,000
Million
times
bucks.
8, so around 900.
I got $1 million.
Yep, $1 million, right? Yep.
Okay. Do
And
you
they're
know-
all 2-1s.
all 2-1s. Okay. And do you know what we can drive this?
Yeah, the potential is 1350.
1350. Okay, what do you know what the occupancy is?
100%.
100%, great. Just gonna leave it at 100% there. And we'll do 95 here for being conservative. What class is this?
It's a C class.
It's a C class, okay. Does it need a whole bunch of work or very light?
No, it doesn't need a lot of work, so I would say light.
Okay. All right, so at the offer price, it's actually not terrible. I have absolutely seen worse than this Delta. Now, being that it's 8 units, you probably, so going back to the debt side of it, do you have some sort of a debt quote for that, or have you talked to any lenders about it at all?
I'm actually starting to. That's why I was asking the information earlier about Jerry, but I'm exploring some, and I have got a rate of around 6.5%, but that was like 15-20 days back. So I'm just trying to see if things have changed.
That's probably gonna be around the same,
Mhm.
just because of the recent news from the feds. So, it probably won't change terribly too much. And in fact, that's pretty damn good. Used to be back, up in the 7s and 8s. So, I mean, we can be conservative and just call it, 675,
Yeah, and I was getting an LTV of 65%
65. Okay.
and an
That's a
amortization.
recourse. It's a bank recourse loan.
Yes,
Yeah.
and I was getting an amortization of 25 years.
Yeah, that makes sense. It's not terrible.
Does that even qualify at the DSCR?
No, this right now it doesn't.
Okay. Oh, you guys have, okay.
Yeah, so so the person you were working with on this loan,
So I'm a W-2 employee, so they were using more of my W-2s to qualify this loan rather than a DSCR.
Interesting. Well, that's one way to do it, right? It'll get you a much lower DSCR if you can back it up with your own. Essentially, you're the collateral.
Right.
So, I mean, let's put this at what you said. I mean, closer to that, just to be more real. And would you happen to know what the expense ratio is? You know, typically,
Yes,
we underwrite at 50.
It's around 45%.
Okay. That's probably going to go up immediately, just, from insurance and taxes.
Mhm.
I don't know if it'll go up by 5%, but probably because it's low. It's a low amount of units. And so, so at this rate, even if it's at 45%, DS, 45% expense ratio, the DSCR is just above 1 at $1 million, right? So, and then your going in cap rate is at about 5%, or in place cap rate is right around 5%. And then as we look at the exit napkin underwriting, let's call it 100% just to, be the same here. We're looking at, potential upside of about $80,000 after you stabilize, which is, it's not nothing, but it's, for investing $1 million, it sounds a little slim to me. So it's either going to be, for me. So I would either look at adjusting the price and see where that could get me, or a loan product differently, or maybe getting a single investor into it to buy it cash, and just kind of promise some of these rates to him with the upside and splitting the upside, etc.
This is great. Aldo, would it matter if this was a bigger number of units? Would that have changed the tide dramatically?
If we stay at 125 a unit at this, so what drives a lot of this is the average rents, man. So, which is why a lot of the times, when we talk to brokers, like, man, I don't know that these rents could support the price that you have on here, which is why, and most of the times brokers are selling on pro forma. They're selling next year's, or even, your stabilized year's performance now. And so, this is why underwriting is very important. So you can be like, man, your rents don't support it. Here's where your rents could support, So let's say that, you coming in here at even at $800,000, you're going in cap at 6.3 and your loan is at 6.5. Now, this could be more attractive if you could get it at 800,000 to a single investor. Say, hey, you park your money here for 6% a year plus some upside, 280 grand. I mean, that's going to add to that. So let's say if they get half of that, so you get your 800 back when you sell, you get 6%, or maybe call it 5%, and you keep 1 or something, or you just on the back end, you say, hey, we'll split the upside profits on this. However you want to do that, right? So yeah, so you have to play around with this, or maybe just be candid with the broker, or I don't know. So anyway,
No, this is good. Thank you for helping me here.
Absolutely. So bottom line is, for those that are new here, you saw me go to the going in cap rate at one indicator and comparing it to the interest rate. If my cap rate now is less than my interest rate, I'm what's called negatively leveraged. I'm not going to be able to make the DSCR payments that I'm required to make, and I'm likely not going to cash flow. So that's a no-no, right? We want to be our cap rate, we want to be higher than what our interest rate is. What we like to see is, at the very least, to even consider it 50 basis points up to $1 or more, so that we can, there's some things you got to cover. Now, this doesn't include what happens year one. So if year one you come in and you start increasing rents, you start making it more efficient, you start working on your upside strategy, then your year one cap rate could be a little bit different and higher, right? So then that's a lesson for, tomorrow's, for the next part of that Zoom. So thanks, Nathan, for bringing that on.
Absolutely. Thank you, guys. Appreciate it.
All right.
Real
What's that?
quick, I want to say one more thing about that overview portion of things. Going back to what we were saying regarding the payments being low and interest only and amortization, all those fun stuff. You'll notice a lot of sellers selling their properties as soon as the interest only period comes to an end, if they're assumable loans, because then it's not their problem. Think of it like that. In the life of holding it, I got to maximize the cash flow, hopefully, if I did it right. I got an insanely great interest rate, which is why it's attractive now. I've increased the property value drastically, or as you should have. And now I get to sell it without having to ever pay the principal. So keep that in mind as well as one reason someone would sell with an attractive assumable loan. So keep in mind on when that IO period ends and when the P&I period starts.
Facts.
One of these days we'll go through a loan agreement, at least the like parts that you need to know, and not all 150 pages, but just some parts that show what your payments are, what the term structure is like, if it's fixed or variable, and so on and so forth. If you guys think that'll be helpful, let us know. We'll be able to go over that. It's pretty quick and easy. I've done it a few months ago. Yeah, it's important to know. Luckily, a lot of the information is on the same page of page number of the document. And anytime I hear assumable loan, that's kind of the first document I ask for. Because you don't want any surprises where it's like, hey, you're closing escrow, by the way, your monthly mortgage or payment skyrocketed because the IO period ended. It's like, oh, nice, that's fun. It's not fun, but yeah, you get what I'm saying.
So Will, you answered the question? I wanted to talk about that a little bit more. Elena asked, what's included in the expense ratio? Did you say tax and insurance? So yes, anything that has to do with the operations of the asset is included in your expense ratio. So definitely taxes, definitely insurance, any kind of maintenance, administration, payroll, if there's any, utilities, anything that whatever it takes to operate the building. What's not included in your expense ratio is what we call below the line items. So things that go below the NOI, like your mortgage payment, your loan payment, that goes below the line. That's not an operational expense. What else? Capitalization or CapEx, either your accrual of the CapEx or your expenditure of it. The expenditure of the CapEx actually goes in the balance sheet, so it doesn't touch your income statement. So that goes below. Sometimes people put an asset management fee below the line as well, so it doesn't hit NOI because it's not an operational expense. So there's few items that don't get included into that. And it's important to know that. It's very important to know that, because sometimes in the T12s and what these people are advertising, there will be items that should be put below the line, like CapEx projects and things like that, that should be below the line are in the operational expenses. And what that does is that it drives down their NOI. So you could have almost an immediate upside if you take those items that are supposed to be below line and drive them below the line. Your NOI shoots up immediately and the value of your property goes up just like that without you having to do anything, just by good accounting, essentially. So just pay attention to those things because they matter.
Also, something to keep in mind regarding expenses is don't get rehab budget mixed up with repairs and maintenance. Two different things. Also, you're gonna have, sometimes it's on the T12 is usually where you see the expenses listed out. Turnover ready is different than repairs and maintenance as well. These are all different ways to say basically almost the same stuff, so it's very easy to get them confused. And then one more real quick question was vacancy is not in your expense ratio. That's more of a, here's the potential rent I could get, your gross potential rent. I'm only getting this much because of my vacancy being at, well, in this example, 0, but usually 5 to 7%, let's say.
It's something that you account for, but it's not an expense.
Correct.
And reserves, the reserves, I would typically put those below the line because they're, capitalization reserves, CapEx reserves. Newbie question, yes, of course. Where does the cap rate come from? Ed, where does the cap rate come from? It feels like it just comes from thin air. No, that's a great question.
Hold on.
I'll give you the definition. What's
Can we do a
that?
little trick? Click on the cap rate cell, double click it, and it'll highlight the formula, and it'll show you what's divided. Boom. Let's go.
That's right.
That kind of goes to my previous point. Use these calculators as a way to learn the questions you have as well. And if we're not there, obviously, we do this an hour a week. This calculator, you can literally click and see where it's getting the numbers from. Double click the cell and you'll see, oh, just took this number, divided it by this number, and now I have my answer. That's what playing around with the calculator, whether it's this or like if you go into like a deeper dive calculator, you could see where these numbers are coming from and you can see how they correlate. And that was the perfect example. So thank you so much for the layup.
Yes,
I
sir.
appreciate the alley-oop pass. Like that was amazing.
That's right.
One more thing, sorry, I want to jump to the expenses, is be careful of OMs or T12s and the insurance and tax number they have, especially a T12, because a T12 only shows what they're currently paying. Your expenses, or sorry, your tax and insurance is almost always going to go up. And like almost is like 100%. Like, especially I'm looking at deal Florida. The taxes and insurance are gonna kill me, but I have to factor it in. So my expense ratio is going to be higher than they have it at. Also, it's important on the T12 and the OM and all that stuff to look at what is in their expense list. Not every expense list has the same, or not everyone has the same expense list. Some people don't put management in there. If it's self-managed, that makes sense. But you need to know that, because if you're not self-managing it, that's what, 8 to 10%, maybe 6 to 10%, if you're lucky. So it's like you gotta know what's going into their expenses by looking at the T12 and understanding, yeah, it's a little tedious, but you go line by line to make sure you're not missing anything big. Where's a good place to understand all the expenses that should be above and below the line? Do we have
Come to our Zoom tomorrow night.
And I think also another good place to look is just you'll look at more T12s and you'll see how they are. Like I personally, for me, the best practice is action, which is how I learn these calculators as quick as I do. And it's really just getting familiar with the documents. I think we did go through the T12 once on here, so we should have it in our YouTube vault.
Also cap rate. Yeah, also cap rate. So definitely check out the YouTube channel for that.
We should plug that more.
I was just waiting for you guys, but I'm just sitting here with sitting back waiting for you guys to finally plug it.
Shut up.
We mentioned it, but we'll post a link on I'm gonna look for the link actually. So while we do that, but also this is why we like having the Q&A section, because you guys aren't all on not everyone's on every call. So please don't ever hesitate to feel or to ask a question. There is no such thing as a bad question as well. So please ask. Jaden, take it away.
So I thought I'd just throw in my 2 cents from what I've heard, and you guys can kind of correct me if I'm right or wrong. So the cap rate gets determined by the location and the area that it's in. But one of the ways you can raise the value of a property, everybody knows you can increase the NOI, and that either means you increase the income or you decrease the expenses. Either way, you've rose the NOI. The other way you can improve the property is to raise cap rate. Now, how do you raise cap rate? Well, you're essentially taking a C class, making it a C plus or a B minus. So you're improving the value of the property. And that's kind of the equivalent to like a fix and flip in the single family space. So to raise cap rate, you're improving the value of the property. However, if you got a C location and you're trying to bring your property up to a B asset, your cap rate is going to be capped by the location. You can't really increase the cap unless it's in a good location. If you got a B location and a C property, you got room to work with. And so then by improving the property, you know, adding in amenities or increasing, you know, you fix up the roof, clean up the paint, you make the property look better. That's kind of another way of increasing the cap rate, so to speak. So that's kind of a way to increase the value of a property separate from increasing the income. That's been my understanding. So
Yeah, so you're on the right track. Sorry, go ahead, man. Go for it.
I was
no,
just
you're
gonna say,
good.
there is one point you bring up that is very important. We always, a lot of the time, we are focusing a lot on what's the property worth today? What are we going in at? And as you see on the calculator, we have the exit cap rate. Why that's important and why I stress a lot about knowing the market and knowing the area you're in. Katie, you bring up a great point. And if I'm planning to exit in 5 years, the cap rate I'm planning to exit at to value my property and forecast that, because every investor and operator is going to ask you, what's it going to be worth at exit? You need to have an idea of what your cap rate is going to be in that market. If you give out a ridiculous number that it's impossible to happen in that cap rate, in that market, your valuation is completely off and everyone's like, okay, well, that's wrong. Like, it's not possible. How are we going to make sure that we are actually getting the return you promised if you're already off with the simplest factor of the equation? You know, like if I'm in LA and you tell me I'm getting 7 cap, I'm like, ooh, how? Like, that doesn't make sense. If I tell you it's a 4 cap, you're like, okay, I get it. Like, I can evaluate it at that. But if I'm in a small city in another state and you tell me 4 cap, I'll be like, you're crazy. If you tell me 8 cap, 7 cap, I'm like, okay, that makes sense. So it's about really knowing your market. You don't want to, on the back end, value something at a cap rate that's not realistic today. Like, what are you forecasting? Like, it's not realistic. So that's a good point.
So you're in the right track, Jaden, I would say. And a couple of things, a couple of points that I would say. So there's a technical term for cap rate, or a technical definition for cap rate, first of all, and it's capitalization rate. It's essentially the returns you would get from a deal if you buy it unleveraged. So if we buy this deal, say at $1 million or $800,000, our returns, if we buy it full cash, would be 6.3%. It would be the NOI essentially, because we don't have to pay anything else below. We don't have to pay debt on it, right? So the returns would be the NOI. So that is an unlevered return at the purchase price. That's what cap rate is technically, right? However, there are market drivers for the cap rate. The cap rate is driven by market drivers, and some of it is, you know, buyers or seller sentiment or whatever, what have you. It's driven. And right now we actually find ourselves in an awkward time where buyers feel like cap rates need to go up, need to expand or increase, and sellers are like, no, we're still in 2022 rates, and they're trying to hold on. And so that happens quite a bit. So there is a determination, there is a market determination or the determinant to the cap rates as well. As far as classes are concerned, when you go up from one class to another, from an asset standpoint, if you bring it up, that's going to be reflected on the rents, right? And so all appreciation that happens on a building is based on its performance, not necessarily the area that it's in. Because I think that plays a role when it comes to desirability to purchase or ability to sell, but it doesn't really come into play into, you know, say the valuation of, you know, this thing. If you bring it up now, if you're in a B class area and your asset is a C class and you bring it up into that B class, what's going to happen is that it's going to reflect on the rents, like I said before, right? But if you bring something up, if you're in a C class area and you bring up your building to a B class, it's not going to get reflected on the rents because you're still in a C-class area, right? You might be able to push, but your market rents aren't going to let you. You might be able to go slightly above because you have a better product, but you're not going to be able to drive your rents the way that they need to in order to maybe meet the investment that you made into bringing it up to a B class, if that makes sense, right? So there's a, so when we look at commercial real estate, we kind of forget about ARVs, right? Unless it's like a 4-unit or less, you know, we could probably do that. Everything's going to ride on the performance of the deal when it comes to increasing rents and getting NOI, or like you said, decreasing your expenses. So yeah, I would say you are probably 90% of the way there. Good stuff. That's because this is really complex stuff. Pete, it's 9 o'clock, man. I don't think we have time for you, bro.
That's messed up.
I'm just kidding, man. You know, I love you, Pete. What's up? Say your piece. Say your piece, man. What's up?
Hold on, your volume's acting up again.
Ours isn't really.
There you go.
No, what's
Yeah.
up, man? Say your piece, brother. What's up?
Well, you know, it's so funny how such a really simple concept can get so complicated. Because you did a great job. I just wanted to try to sort out the confusion about cap rate, and you did a great job of doing that. And we won't sort it all out tonight, right? It takes some time to think through it and figure out how it works. But Ed mentioned the calculator, the spreadsheet, and the spreadsheet is great for seeing the calculations. That doesn't always help you understand the concept, but just to reiterate what you said, that's exactly what it is, right? It's the cap rate is the return on your unlevered investment, on your investment with no leverage. So if you pay $1 million, it's a 5% cap rate, you're going to collect $50,000 a year. That's what the cap rate tells you. You've got the cap rate of the building of the asset, and then you have the market cap rate. Those are two. Really, they're related, but they're very different, right? You calculate the cap rate of a building, of an asset. You don't calculate the market cap rate. The market cap rate is what it is based on the sales of assets in that market. And like Aldo said, is the thing that drive that is demand. That's if you have a whole bunch of buyers that want to own assets in a market, the prices are going to go up, the cap rate's going to go down. And that's the other thing that gets confusing about cap rate, is you have to remember that it's an inverse relationship to the price. So that was the other thing I wanted to mention about what you were saying, Jade, as you talked about raising the cap rate. When we buy an asset, we're not trying to raise the cap rate, right? We're trying to raise rents and trying to lower expenses. And when we do that, we increase our return. So I guess you could say increase the cap rate, but you really want to buy high. And when it comes to cap rate, you want to buy high and sell low. You want to buy low on price, high on cap rate. You want to sell high on price, low on cap rate. So those
because
two
you're dividing your returns by the cap rate.
Correct. So that might have cleared something up for some people. That might have made some people go, I thought I had it figured out. Now I'm totally confused. And that's okay. That was the point. It is a simple concept that with a lot of complexity, and you just over time it'll click. The more you hear it, the more you think about it, the more you think through it. Oh yeah, as the more I can look at it this way. I'll say one more thing that maybe it'll help. If I have a building that's generating $50,000 a year, if I sell it for $1 million cash to a cash buyer, that cash buyer is going to make 5% on his money. If I sell it to him for 1.2 million, he's not going to make 5% on his money. He's going to make less than 5% on his money. That's why the cap rate goes lower as my sales price goes higher. If he negotiates a better deal and buys that same building for me for $800,000, Now his cap rate just went up. And that's why we're trying to buy high by lowering, buy high on the cap rate by lowering the price and sell low on the cap rate by raising it. So hopefully that helps clear up that concept. So,
Thanks, Pete.
Yes, sir.
Thank you,
Thank you
guys.
very much.
Thank you,
that
Peter.
was a great call.
Chiming in. Yeah, absolutely. And yeah, thanks guys for coming out. You know, we could be here for another 2 hours, I bet, talking about
2
this
days,
stuff.
2 months.
Yeah, that's right. That's right. But hey, stay tuned, come back next week and we'll talk some more about this stuff, and make sure you join tomorrow where Victor's going to go deep into the T12. So you won't want to miss that.
Peace.
And come back on Monday. We need more people on the broker call.
I'll be there. I'll be there.
Hey, Pete, sounds like we need to talk about a deal down in Atlanta. Let's
Yes,
go.
we do. Yep.
Yes, sir. Let's do
Let's
it.
go.
Let's connect.